Okay, so in the last episode, we were talking to Ty Coleman. He's a mortgage broker, and we were seeing the top reasons that people are denied a loan. Okay, in this episode, Ty is back and he's going to tell us how to fix your credit if you have bad credit. And he's made a crazy claim. He said that if you, regardless of how jacked up your credit is, if you just do the things he says, he can help you get into a home. Okay, so time to put up or shut up. Welcome to the show. Thanks for coming back, Ty Coleman.
No problem.
You are listening to The Leadersmith, Darren Gerdes.
Okay, so Ty, you claim that if people just do what you said, that you were a credit counselor for how many years? How long?
For about 2 years.
For about 2 years. And you saw some pretty messed up credit, right?
Yes.
Yeah. Okay. So I want you to tell the audience what they can do if they want to get into a home, and you're a mortgage broker now. So if they want to get into a home, what they need to do in what order in order to get that done. So I want you to instead of go top 10 the way that we did before in the last episode when you were talking about the issues that will deny you a loan, and the first one or the last one was the most important. I want you to say do this, then do this, then do that, and work us through that. Okay. So if you have bad credit, here is the absolute first thing that you should work on. What do you fix first?
All right. So the first thing you need to do is work.
Okay.
I know that sounds like a common sense thing, but you need to work. You need to have consistent income, and you need to budget according to that income. So first, work. Okay. Have money coming in. And then next.
So whoa, before you go on to next, stay on work. So if somebody's out of work because of COVID, or unemployment or something like that, that's probably is that gonna retard the process and keep?
Yeah, if it's going to mess up your process if you cannot pay your bills, one, because it's going to affect your credit, but then it's also going to mess up. It may mess up your progress if if you have a large gap in your work history. Okay, so I know this COVID time, a lot of lenders are giving some leeway and understanding to that, but you can't have a lack of work history for too long.
Yeah, and in the last episode, you were telling us about how you had to have 2 years of a consistent work history.
Yes.
If you don't have that, that's going to scuttle the process. So that makes
Right.
sense. Work history. So you got to be working. And I learned a lot. I didn't know that you had to be in the same field
Oh, yes.
in that process. Okay, so that's number one, work. Okay.
All right. So next is irresponsible credit purchases. You do not want to have that. What I mean by irresponsible is that you're basically borrowing more money than you can afford.
Okay.
That is going to, honestly, just more than just purchasing a home, but that's going to affect all areas of your financial life. Okay. If you can't pay your bills, then your credit is going to go low. If you can't pay your bills, then you're going to have insufficient funds in your bank account. You can't pay your bills, you can't save money. So it really affects a lot of different areas of your financial life there. So irresponsible credit purchases really will mess things up for you, and specifically in credit, as far as your credit score, it will end up making you drop your credit score.
Okay, so let me paint a picture for you. If I understand correctly, you're just looking in black and white. You're looking at numbers on paper. You're not this person might think, well, it's not irresponsible because I need a new car so I can get to work. The bank doesn't care. Is that fair? They're looking at it costs too much every month. Don't let me put words in your mouth, but that's how I would deal with that concept that you just provided. Is that fair?
That is correct. We are looking in black and white, and your situation, if it lends that you are spending way too much money right now, more than you can afford, then we can't put more debt on you, because you're not going to be able to afford our debt either. So,
Okay, so
uh,
what do they need to do if they have irresponsible credit purchases
mhm. So,
already there? What do you do?
so what do you do? What you do is you make a budget. Okay. And I used to help people with budgets all the time. You make a budget and see first where you want to spend your money according to what your needs are and your wants are. Okay. You want to satisfy those needs first. And when you satisfy those needs, whatever is left over will go to those wants. Okay. There's times where your credit will take a hit, because of that, but sometimes it's necessary.
Okay.
Either way, you want to uh, pay off any debt that you can according to those needs first and then those wants. But you want to pay off any debt that you can as fast as possible. So any leftover money, you want to throw as much as you can at that debt to get it down. Okay.
Okay.
Um, and sometimes that means you might have to pick up a second job, to pay off that debt. But you want to eliminate debt as soon as possible. That way you're not stretched so thin.
Okay. What's the next step? So you've
Mhm.
already said get to work and then take care of irresponsible credit purchase, get rid of those debts as much as possible. What's the
Mhm.
third step?
So the third step is, really lower your debt to income ratio. We spoke about that before, but
Explain that again, because some people
okay.
haven't listened to the other episode.
Okay, yep. So your debt to income ratio is basically saying what percentage of your income is taken up by your debt.
Okay.
Okay. Um, there are some times when I get a borrower and they already have 40% of their income taken up by their debt before I even add the payment for a house. So now you only have, in some loan programs, you only have 5% left in your income to be taken up by debt, which means that you're probably not going to get a house that that you will want because the loan amount is going to be so little. So what I would say is, going to our last point, is this is also where you want to eliminate debt. Okay, so you want to make good payments and eliminate debt in order to maximize your debt to income ratio. So you want to make your debt to income ratio as little as possible so you can afford more house if you want to.
So these are intertwined, if I'm hearing you correctly. Like if you
They
do
are.
number two, if you remove or reduce the irresponsible credit purchases, it
Mhm.
automatically creates a better debt to income ratio.
Yes. Yep.
Okay, gotcha.
Yep.
Okay, what's the next one? Number four.
Okay, so you want to have enough money to cover transactions. Okay, uh, that means you're going to be saving money. Okay, or I mean, in the mortgage industry, we can also count, um, you know, your retirement, or 401k, or IRA as part of your assets. Um, you want to have some money aside to make the transaction work. If you're coming in with no money, it's that's not going to work. So you want to have something put aside. Now there are times where you can have a little bit in a savings account, but you don't want to run that risk.
So
Okay,
are you talking about for money down or just a transaction cost or both?
both, both
Okay. And
down
it used to be that
transaction
like you
costs.
had to have 20% or maybe 30% to put
Uh,
down on a house. We're not in those days, right?
no, we're not. No. So if you're a first time home buyer under conventional, you can have 3% down. Um,
Wow.
Under FHA, you can have you have to have 3.5% down. So you don't have to have 20% down right away if you're a first time home buyer. If you are a repeating home buyer, and say you have a property and you want to buy another property, um, you may have to have more down, depending on the loan product. So
Okay.
so yeah.
All right. What's the next one?
Yeah. So our next one is negative items on the credit. All right. So we talked about this a little bit last episode, but negative items meaning late payments, yeah, collections, charge offs, things like that. Again, you want to eliminate or limit those things.
How do you do that?
So the way you do that is, well, going with our third point, of getting that debt to income ratio better. What you want to do is you want to pay off, I would say, anything that is less than 2 years first. So you want
Okay.
anything that's less than 2 years.
Huh.
What that's going to do is going to help your credit score faster than something over 2 years. Okay.
Wow. So you know something I don't know because I would have thought you got to pay off the older debt, or maybe you pay off the smallest debt so you pay off more. But you say just look at what's the newest, pay
Yep.
that off.
Yep. Look at the age of your debt. Specifically, the way you calculate the age of your debt is according to your date of last activity.
Okay.
So if I had a collection and the last time I paid that collection was a year ago, last year, that's going to be my date of last activity. Um, but my open date may be older than that.
Okay.
So you want to pay attention to the date of last activity because that's where you count the age of that account.
That's really interesting. I would have gotten that completely backwards. I would have gone for like that 16-year-old thing that I haven't really touched that, trying to do right and thinking, well, that's probably the one that's harming me most. But you say the opposite.
Yeah.
Okay.
Uh-huh. So what you want to do is take that account and you want to pay it off, or you can settle it. You can negotiate with the creditor and see if you could pay less to satisfy that debt. Things like that you can do kind of to save money at the same time, but you want to get rid of those negative items there. Uh,
Okay.
that'll also help your credit score go up too.
Okay. What do you address next?
After that, you really want to address if there's any kind of uh, defaulted government loans specifically.
Okay.
Um, if there are any, those need to be satisfied as quickly as you possibly can. Now, with satisfying those debts, a lot of times the government doesn't allow you to settle, so you
Mhm.
will probably need to um, have the total amount satisfied, the total balance satisfied. And sometimes that can be in payments. Okay, if you have the money, all the money up front, you can do that as well. But it will not come off your credit until the total amount is satisfied.
Oh, okay. So yeah, government's going to deal with it a little differently because they're the government.
Right.
So
Exactly.
yeah, okay. So what's the next item or what's the next process?
Okay. So the next process is we want to build up your credit score. Now we talked about certain ways that you can build up your credit by paying off things, also having good credit history, which are making sure that you are paying everything on time. But there's other ways as well. Maybe getting a secure credit card, uh, keeping the balance under 30% of
Mhm.
where that credit limit is. Um, you want to make sure that your payments on that new credit is on time. There's also a nice tool now that Experian came out with Experian Boost. Um, that'll help. That helps many people with the initial boost of getting some points on their credit. The way that works is you're signing up, maybe your electric bill onto Experian Boost, and what Experian Boost does is it'll connect to your bank account and see when you paid that electric bill and if you paid it on time over maybe the past 3 months or more, and then it'll
Okay. Huh.
end up giving you credit for all those past payments, and it boosts your score pretty quickly.
So here's another counterintuitive thing. Like you don't want to just pay off your debts in cash either. You're trying to create
Mhm.
a record, right?
Yes.
So even if you're
Yes.
paying all your debts in cash, that's not helping you at all, right?
Right. Yeah. You want to pay it, and you want to see your payments in your bank account.
Okay. So, okay, well, I mean, it's good to know those kinds of things. Okay, what is next? After that, the next approach or next thing that you would
Okay.
do is
Yep.
what?
So you want to make sure, as we talked about your, having pretty much a track record of your payments and everything. We want to make sure that all of your handling of money is upfront and honest. Okay.
Okay.
So we don't want to see any kind of uh, false statements or anything like that on your paperwork.
Mhm.
So the way that happens is honestly be honest. All right.
Okay, that's pretty easy.
Yeah. Now there are times where you're going to not remember certain things, such as exactly when you started a job. You might
Sure.
get the day wrong or maybe even the month wrong, but you got a general idea when you started a job or something like that. Um, or same things with your payments and debt and all that stuff. You're not going to get it exactly right, but you want to make sure that you have it in order, in enough order in order to give somewhat of a ballpark figure of dates and times and things like that.
Okay. Next.
Yep. Next is all right. So we don't want any fraud going on.
Okay.
So whether it's in your smaller items, okay, like credit cards or installment loans or anything like that, or your bigger items, like a house, okay, or a vehicle. We want to make sure that who who is paying the item is actually who they are. Okay,
Okay.
we don't want Uncle Joe from Ohio um,
Right.
this debt at the same time you're claiming the same debt in a fraudulent way. Now that's not to say that you can have a borrower and co-borrower on a loan, and that's fine. But you don't want underage Mikey paying some debt that you have because he is not legally allowed to. So um,
Gotcha.
so there's things like that you want to make sure that you have in order.
Okay. It seems like if you've done all these things, you're a long way toward being credit worthy enough to get a mortgage.
Yeah, and these are really simple, normal things. Yeah.
Okay, what's left? There's a couple more?
Yep, there's a couple more. All right, so changing jobs, you need to have consistent income. Um, we talked about that earlier on. Consistent income is a big thing. That's how you're going to arrange your budget. That's how you're going to end up paying off all of your debt. That is how you're going to pretty much manage your financial situation throughout your life is by keeping consistent income. If you're jumping between jobs and fluctuating income all the time, that's not a stable financial life there. So you want to make sure that you are being stable in your income.
Okay. So if they do all these things that you just described, I
Mhm.
mean that seems like a pretty healthy list of doing those things and you get the biggest bang for the buck in the first one that you described and you work all the way through this process. In a year, somebody with really jacked up credit is going to get where they're trying to go. Is that fair?
Yeah, yep. As someone with bad credit, I mean, they do these things.
What's
It,
the worst that you've seen?
um, credit in the low 400s.
Okay, and describe that range again. It goes from what to what?
So we're looking at, I believe the credit scores start at, I believe 350. I've never had one that low
So if
before.
you're in the low 400s, that's pretty
Yeah,
bad.
yeah.
Yeah.
And then you're all the way up in the 800s. So you really want to, obviously you want to get as high as you can, and the best way is to, let's say, maybe have two installment loans, two credit cards, and working those two or those four items very well where there is no flaws in your payment history, that everything is paid on time, and and that your balances are low in your credit cards. That is really key, and that's probably the biggest score booster that you'll have in your credit is having low balances.
Now, you said obviously you want to have it as high as you can, but I don't think it's obvious to everybody. Like, I think some people might be thinking once I get over X bar 750 or whatever it is, or
Mhm.
700 or wherever they have in their mind, I'm good to go. That's not right.
Mhm. Well, if that's where you want to be, that is right. However, the the higher your credit score is, the higher your credit worthiness is, and it's easier to get a loan. However, 750 is pretty solid, so I don't think anyone would have a problem with.
Well, whatever the number is, don't you get a better interest rate depending on your
Yes,
now how does that tangibly affect you?
yes. So higher the score, the better the interest rate on any loan product, which means the lower your payments per month on that product.
But
Um,
how much can that really I mean, is that just a couple dollars or is that a significant difference?
uh, so let's say if you have let's say a 620 credit score on a mortgage,
Mhm.
and you have a 750 credit score, someone else with a 750 credit score, that's going to be a significant difference. That could be, a couple $100. So it
Couple
really
$100 for what? For the year?
for your monthly payment.
For your monthly payment?
Yes,
Wow.
depending on the house that you buy. If you're going to buy something that's less expensive, then the change in that payment is going to be less because it's going according to the percentage of the loan amount.
Okay. So if
So
I'm hearing you right, if you have better credit, you can get a lower interest rate.
mhm.
That sounds almost like discrimination. No,
It-
you're following what I'm saying?
oh
Like,
yeah, yeah,
so if you can get yourself higher, you can get
mhm.
yourself your interest rate lower if I'm following you.
Right. But if we're going to count as discrimination, is discrimination according to good and bad uh, practices according to your finances.
Okay.
These are decisions that you're making, not discrimination. According to something like skin color that you have no control over.
Yeah, yeah. So if I'm hearing you, you have control over this. If you just follow the steps that you outlined, you can actually get to the place where you can not only get the mortgage, but get a better mortgage if you just
Hmm.
do these things.
Exactly.
Wow. Okay. So now I want to turn this because the podcast is all about leadership and I want to talk about success. So if I'm hearing you right, um, if they do these things, there are going to be other effects as well, right? I mean, like
Yes.
they're not just going to be more credit worthy. And you see all you're seeing, do you meet the people and make your decisions that way, or is it all
It-
paperwork?
I have to make my decisions off of the paperwork, but I do meet the people as well.
Okay. So, but essentially, like you could just look at the papers and decide just from that without, you know, hi, Mr. Jones, it's nice to meet you. I mean, like the black and white of the paper is what's going to drive the decisions, right?
Yes.
Okay. What do you think are the spillover effects? Like if you're doing these right or if you're doing these things wrong, can you tell kind of what's going on in the rest of their life?
Oh yeah. So honestly, if they're doing these things right, you can see, and this is going to sound interesting, I guess you say. You'll see a happier person walk in the door.
Oh, that's interesting.
Interesting, right? Because they're not stressing over their finances,
Mhm.
right? You can see the success that they have with their jobs uh, overall, because because it's not just in their finances that they're having these consistent practices; it's also in the rest of their life.
Yeah.
Um, so they're probably going to be going up in their job, and then also they're probably not going to be stressed out about their money because they've budget correctly. Okay, they're not stretched too thin, and they're able to handle the things that come their way. And honestly, that ends up branching out to all aspects of their life. Usually.
Yeah. Yeah, yeah. I noticed a spillover effect in a similar way. When I started
Mhm.
exercising, guess what? I started eating right. because I
Mhm.
was thinking like, this was hard to do that exercise. I'm not gonna, go and undo it with,
Right.
this cream puff where I should be eating vegetables, right? So
Exactly.
so exercising led me to eat right and then work harder and then whatever. So there's this spillover effect, and I would imagine it's the same kind of thing here financially. If you get those financial pieces in order, you start to do other
Mhm.
things a little differently. You control that
Yep.
impulse spending a little bit more. And
Exactly.
just right. Okay. Okay, Ty, thank you so much for your time. And just as a disclaimer, I know Ty. We go to the same
Mhm.
church, same small group. He's a great guy. I personally would vouch for him. Ty, if people want to, they've heard you and they want to reach out to you, how do they contact you?
Yes. So I'll give you my email. It's T Coleman, spelled TCOLEMAN at P for Premier, N for Nationwide, and then the word lending, LENDING.com.
Okay.
That's my email. That's the way you can get in touch with me there. Or my phone number is 610-505-2514. And you can also, when applying for a mortgage, you can also apply on my website at tyronecoleman.com.
Okay. Now, I always close my episodes with the quotation for contemplation. I didn't do it last time because we were over time, and then I was going to invite you back because we started talking about credit, and I wanted you to be able to do this as well. But here's the quotation for contemplation. I think it works really well with everything you just said here today. It's from Tony Robbins. He said, if you want to be successful, find someone who has achieved the results that you want and copy what they do, and you'll achieve the same results. This
Yes.
isn't rocket science, right? I mean, if you just figure out like somebody else did it and you just copy what they did, you'll get where they're trying to go to. And if they
Exactly.
come to you, and I mean, that's a pretty big boast to say, look, in a year, I can have you in a house, but you
Mhm.
have to do it this way.
Right.
So if you want to talk to Ty and figure out how to do that, again, a mortgage broker who was a credit counselor, I mean, that's like, hey, you've got it all together in order to help these people get where they're trying to go. So thank you for
Yes.
your time. Thank you for coming on. Is there anything else that you would like the audience to hear before we close out?
Yeah. Well, just know that I'm here and that I can help you in your financial situation, and I will be happy to. And God bless.
All right. Thank you for coming on.
Thank you.